Let me ask you something. Why do investors always believe the best opportunities are somewhere else? Somewhere across an ocean, wrapped in a different currency, under a different flag. It's almost human nature to think the grass is greener abroad. But in investing, that's the illusion that costs people fortunes. Because while everyone's chasing what's moving now, the real wealth is quietly being built by those who stay disciplined, keep costs low, and let time do the heavy lifting. The truth is, you don't need to own the whole world to succeed. You just need to own your share of it, understand it, and hold it long enough for compounding to work its magic. When investors reach for opportunities beyond their borders, they often do it with optimism and curiosity. They see foreign markets rising, headlines promising growth potential, and the illusion that more diversification automatically means better results. But the thirst is, every time you step outside the structure you understand, you take on extra layers of risk, layers that quietly erode simplicity, transparency, and control. Investing is never about chasing what looks good. It's about understanding what you own, how it behaves, and what it costs. And foreign markets make all of that harder. Let's start with the most obvious currency risk. When you buy foreign stocks, you're not just betting on companies, you're betting on the value of another country's money against your own. That's a second layer of volatility, and one you can't predict or control. A great company overseas can deliver strong returns, but if the local currency drops against yours, your profits vanish. The movement of currencies has nothing to do with the underlying performance of businesses. It's speculation wrapped in unpredictability. That's not investing. That's introducing a variable that has no long-term reward you can count on. Then there's political and regulatory risk. Every country has its own laws, institutions, and enforcement mechanisms. Some protect shareholders, others do not. Some report earnings truthfully, others hide liabilities until it's too late. You might think you're investing in growth, but in reality, you're trusting an accounting system in a legal environment you don't live in or understand deeply. When a government decides to nationalize an industry, change tax rules, or impose capital controls, foreign investors pay the price. These are risks you can't research your way out of. They're systemic, unpredictable, and largely uncontrollable from your side of the world. Even a simple act of getting reliable information becomes more difficult. The further you go from your home market, the murkier things get. Financial statements are different, disclosures aren't as transparent, and investor protections are weaker. You can't rely on the same level of oversight or scrutiny that exists in more established markets. That means what looks like diversification on paper may actually be an illusion. You're not necessarily reducing risk. You might just be trading one kind of risk for another, harder to see, but more damaging when it strikes. Costs also creep in quietly. International funds often carry higher expense ratios due to trading costs, currency conversions, taxes, and administrative layers. Those fractions of a percent may look small, but over decades they accumulate and eat into returns. The very simplicity that makes domestic index investing so powerful, low cost, low turnover, clear ownership, gets diluted when you step into the global maze. And that's before you even consider liquidity. In smaller or emerging markets, it can be difficult to enter or exit positions without affecting prices, which means investors pay invisible premiums every time they trade. Simplicity isn't just a philosophy, it's a form of defense. It keeps you close to what you can know and control. It strips away the noise that markets constantly throw at you. Complexity, on the other hand, disguises risk as opportunity. It tempts you to believe that more moving parts somehow equal greater sophistication. But the truth is, the more complex your investments, the more fragile they become. Every additional layer, currency, geography, politics, regulation, adds another point of failure that you can't see until it's too late. When you own a broad domestic portfolio, you already hold exposure to the world. The largest companies you own are global enterprises. They manufacture abroad, sell abroad, earn abroad. You already have foreign exposure without crossing into uncertainty. That's enough. The goal of investing is not to collect flags on a map, but to own productive assets that compound your wealth over time. So when you look at your portfolio and feel the urge to chase that extra return across the ocean, ask yourself what you're giving up in clarity, cost, and control. More isn't always better. Sometimes more is just more risk hidden behind complexity, disguised as opportunity. The greatest strength of a sound investor is knowing when simplicity beats sophistication, when staying home beats wandering too far. In the end, you don't need to own everything to own enough. Many investors assume that to capture the growth of the global economy, they must own stocks in foreign markets. The idea sounds logical. If the world is growing, shouldn't your portfolio reflect that world? But what's often overlooked is that you already participate in global growth every single day through the companies you own right at home. You don't need to cross borders to gain international exposure. It's already built into the fabric of the businesses you invest in domestically. Look at the largest companies in any developed market. They are not local corner stores confined to one country's borders. They are vast global enterprises operating across continents. Their factories, supply chains, and customers stretch from New York to Tokyo, from London to Shanghai. When you buy shares in these companies, you're not just investing in your home economy, you're buying into the global economy. Take a single major technology or consumer company, and you'll find that a large portion of its revenue comes from international sales. They earn profits in multiple currencies, adjust to foreign demand, and compete worldwide. That's real diversification already embedded in the shares you hold. This built-in global footprint is one of the most underrated advantages of domestic investing. You get access to international growth without the burden of foreign currency swings, political instability, or the lack of transparency that often clouds overseas markets. You benefit from the innovation, efficiency, and earnings power of firms that have already done the work of expanding internationally without personally taking on the risks and costs of owning those foreign shares directly. It's a cleaner, safer, and far more efficient form of global participation. Consider what happens when the global consumer spends more, when emerging markets grow wealthier, or when foreign economies strengthen. The companies headquartered in your own country, the ones listed on your home exchange, are usually among the first to benefit. Their products sell in those markets, their services are consumed abroad, and their profits reflect global activity. You don't need to own a Japanese automaker to profit from Japanese car sales when your own domestic company competes in that same market. You don't need to own a Chinese tech stock to gain exposure to Asia when many domestic firms already rely heavily on that region for growth. Moreover, the governance standards, transparency, and investor protections in your home market add an invisible layer of security that international markets may not offer. You can trust the accounting, the regulation, and the oversight. You can read company reports that adhere to familiar standards. You can understand how those firms are managed, what their risks are, and how they disclose them. That knowledge, that clarity is worth more than chasing marginal diversification through foreign holding. Because when things go wrong, being able to rely on rules and institutions that protect investors becomes priceless. There's another layer of benefit that few investors appreciate: efficiency. Your domestic companies have already absorbed the cost of global expansion. They manage their own currency risks, navigate international trade rules, and adapt to political shifts abroad. In effect, they are doing the hard work of global investing for you. You, the shareholder, enjoy the results through earnings growth and dividends without having to juggle foreign taxes, fund expenses, or local market volatility. That's simplicity serving you well. So before you look overseas, take a closer look at what you already own. A diversified domestic index fund holds hundreds or even thousands of businesses that sell to every corner of the world. You may already be more globally diversified than you think. The profits of those firms are shaped by worldwide demand, international supply chains, and global consumer trends. The world's success flows back into your portfolio naturally. True diversification is not about owning companies in different countries. It's about owning companies that thrive across different conditions. Many of your homegrown corporations already meet that test. They stand at the intersection of global trade, innovation, and consumer behavior. Through them, you already share in the world's prosperity. In the end, you don't need to chase every market to participate in global growth. The world's future is already reflected in the strength and reach of the businesses you hold. Investing doesn't have to be a passport exercise. It's about owning productive enterprises that endure and expand wherever opportunity exists. And more often than not, that opportunity is already working for you right where you are. When you invest in your home market, you play on familiar ground. You understand the rules, the regulators, the accounting standards, and the economic rhythms that shape business performance. That familiarity is not a small advantage. It's one of the most powerful edges you can have as an investor. The further you drift from that center, the more uncertain your footing becomes. The home market offers efficiency, transparency, and accountability that are often unmatched anywhere else. Those qualities make it the most reliable base from which to build long-term wealth. One of the defining strengths of a developed home market is its efficiency. Prices reflect information quickly, trading costs are low, and liquidity is deep. When you buy or sell, you're not penalized by wide spreads or hidden barriers. This efficiency ensures that you can participate in the market's growth without being disadvantaged by friction or inefficiency. In contrast, many foreign markets are thinner, slower, or distorted by government intervention. That means prices may not reflect fair value, trades may be expensive, and information can take time to reach investors. You want your investments to work for you, not against you, and the structure of your home market is designed to do just that. Regulation is another cornerstone of this advantage. A well-regulated market protects investors not by promising high returns, but by enforcing fairness and transparency. Corporate governance rules, auditing standards, and disclosure requirements give you confidence that what you see is closer to the truth. It's not perfect, no system is, but it's stronger than most alternatives. When you invest abroad, that protection weakens. You might not know how companies are valued, how their books are kept, or what rights you have as a minority shareholder. In your own market, the regulators work under a familiar legal system that you understand, one that prioritizes investor rights and enforces. That's the kind of security that compounds quietly year after year. Familiarity also gives you an emotional and intellectual advantage. You know the culture of the companies you invest in. You understand the economic trends that affect them, the consumer behavior that drives their sales, and the policies that shape their industries. You can interpret the news with context. When headlines appear, you can judge whether they're meaningful or just noise. That kind of insight is almost impossible to replicate when you invest in markets halfway around the world. You may read about a political shift in another country, but you can't feel its real impact the way a local investor can. By staying close to what you understand, you reduce the risk of reacting to speculation or misunderstanding. There's also the matter of trust. In your home market, you can rely on the credibility of institutions, stock exchanges, regulators, auditors, courts that exist to maintain fairness. That infrastructure isn't universal. In some markets, corruption, opaque practices, or government interference aren't part of the landscape. Investors there may face arbitrary rule changes or reporting manipulations that would never be tolerated at home. When you stay invested where standards are strongest, you align yourself with a system designed to protect long-term investors rather than exploit them. Efficiency, regulation, and familiarity together create an environment where long-term investing can actually work as intended. You can plan with confidence knowing that your capital is treated fairly, that markets function smoothly, and that your understanding of the landscape is grounded in reality. That's an enormous advantage, one that doesn't show up on performance charts but matters far more than a few points of annual return. The temptation to go abroad often stems from the belief that foreign markets will deliver something your home market can't: higher growth, greater opportunity, or more diversification. But growth means little if it's unpredictable. Opportunity means little if it comes with instability, and diversification means little if it adds complexity and confusion. Your home market offers something far more valuable: clarity. Clarity in rules, in values, in information. In the long run, investing is not about chasing what's new or far away. It's about staying grounded in what you understand and what you can trust. The home market gives you that foundation. It gives you efficiency when you trade, protection when you invest, and context when you decide. That's not a limitation, that's the power of familiarity. The greatest advantage an investor can have isn't exotic access, it's understanding, and that understanding begins at home. There's a common misconception among investors that a portfolio isn't truly diversified unless it includes foreign stocks. The financial industry often repeats this mantra as if it were an unbreakable law, as though you're missing something vital if you don't hold a slice of Europe, Asia, or emerging markets. But investing is not about checking boxes, it's about understanding risk and reward, simplicity and purpose. There is no rule that says you must own foreign stocks. And if you choose to do so, the key is moderation, a measured, limited allocation that doesn't compromise the integrity of your core portfolio. The world is a complicated place. Each country has its own economic cycles, political structures, and currencies. To think that you must expose your portfolio to all of them to succeed is to underestimate the strength of a disciplined, domestic-centered. The truth is that a globally diversified portfolio doesn't need to include every market on the planet to capture global growth. The large, well-managed companies you already own through domestic index funds are often multinational by nature. They operate on a global scale, earning revenue from every continent. You're already participating in the world economy without consciously seeking it. Now, that doesn't mean foreign stocks are worthless or that they have no place at all. It simply means you must approach them with clarity, not compulsion. A small allocation, say 10 to 20% of your equity portfolio, can be reasonable if it helps you stay comfortable and confident. That's not a requirement, it's an option. A limited exposure can offer a touch of diversification during certain periods when foreign markets outperform, but the key word here is limited. When investors overreach, chasing the promise of global growth, they often find themselves adding complexity and volatility instead of stability. Foreign markets come with different sets of risks: currency swings, political uncertainty, weaker corporate governance, and in some cases, unreliable financial reporting. You can't wish those away. When you put a large portion of your wealth into unfamiliar markets, you're essentially trusting systems you don't fully understand. And trust is not a substitute for knowledge. The prudent investor always stays closest to what he can know, measure, and control. Limiting your exposure to foreign stocks doesn't mean you're being narrow or short-sighted. It means you're prioritizing simplicity, discipline, and the long-term compounding of your capital over the illusion of sophistication. Investing is full of temptations, and one of the greatest is the idea that more is always better. More markets, more funds, more movement. History shows that success in investing doesn't come from owning everything. It comes from owning the right things at the right cost and holding them through the right time horizon. When you keep your allocation to foreign stocks small, you're also protecting yourself from the psychological burden that comes when markets abroad behave unpredictably. Imagine watching currencies collapse, governments change course overnight, or foreign economies slow down for reasons you can't anticipate. That kind of volatility can lead to emotional reactions, panic selling, frequent rebalancing, or second-guessing your entire plan. Limiting exposure keeps those risks manageable, allowing you to stay steady even when the world looks uncertain. In the long run, your returns are determined less by how many regions you invest in and more by how you behave as an investor. Cost control, patience, and consistency will always matter more than geographic reach. A broad domestic index fund offers more diversification than most people realize, often containing exposure to thousands of companies across countless industries. Adding a small portion of international stocks can provide a minor extra layer of diversification, but it won't transform your results. What will transform your results is sticking with a clear, low-cost, long-term plan. So don't let anyone convince you that owning foreign stocks is mandatory. There are no commandments in investing, only principles. Few invest abroad do so sparingly and thoughtfully, not because the world tells you to, but because it makes sense within your own understanding and comfort level. The goal isn't to own everything, it's to own wisely. The investor who keeps his portfolio simple, disciplined, and grounded often ends up doing better than the one who endlessly searches for something extra across the globe. Sometimes the smartest move is not adding more, but knowing when enough is enough. Every investor faces the same temptation: to look beyond what's steady and familiar, to chase what seems to be working somewhere else. The financial media thrives on that temptation. The stories of emerging market booms, Asian miracles, or European rebound, they make it sound as if you're missing out if you're not jumping from one global hotspot to the next. But the truth is, the most successful investors don't spend their time chasing what's moving now. They focus on what they can actually control. And what you can control, costs, diversification, and your long-term horizon, matters far more to your future wealth than any promise of short-term global excitement. Start with cost. Every dollar you pay in fees is a dollar that will never compound for you. It's gone forever. The global investing industry loves complexity because complexity hides costs. International funds tend to carry higher expense ratios, management fees, currency conversion costs, foreign taxes, trading spreads, and more. All those invisible drags quietly chip away at your return. Doesn't seem like much in a single year, but over decades, the difference between paying more 0.10% and 1% annually can add up to a life-changing amount of money. The math is simple, but investors often ignore it because excitement sells better than arithmetic. You can't control what the market gives you, but you can absolutely control what you pay to participate. The lower your costs, the more of your own return you keep. Then comes diversification, true diversification, not the illusion of it. Buying funds scattered across the world might make you feel diversified, but if those markets move together during crises, the benefit disappears. Real diversification is about spreading risk without sacrificing simplicity. A broad, low-cost index fund tracking your home market already gives you exposure to thousands of companies across every major industry, many of which earn revenue globally. You don't need to add layers of international holdings just to feel safer. In fact, adding too many layers often increases correlation, complexity, and cost, the very things you should avoid. Diversification should protect you from unnecessary risk, not introduce new kinds of. And finally, there's your long-term horizon, the most powerful tool an investor has. Time smooths volatility. It rewards discipline and punishes distraction. But time only works for you if you let it. When you chase overseas opportunities because they're popular today, you break that long-term rhythm. You become a trader in disguise, reacting to headlines rather than building wealth patiently. The market will always give you reasons to look elsewhere, promises of faster growth, higher yields, or once-in-a-decade opportunities. Most of them fade just as quickly as they appear. The investor who stays the course, who keeps compounding quietly, always ends up ahead of those who are constantly in motion. The beauty of focusing on what you can control is that it keeps you grounded in reality. You can't control interest rates, inflation, or global politics. You can't predict which country's market will outperform next year, but you can control how much you pay, how broadly you diversify, and how faithfully you hold for the long run. Those are the levers that actually shape results. The irony is that by focusing on the simple things, you end up doing the hard thing, outperforming the crowd that's always chasing what's new. The promise of overseas hotspots has burned more investors than it's enriched. It plays on the same emotion that drives all speculation, fear of missing out. But real wealth is never built on fear or excitement. It's built on consistency, patience, and cost discipline. When you keep your attention on what you can control, you protect yourself from the noise that destroys so many well-meaning investors. In the end, investing isn't about discovering hidden treasures in faraway markets. It's about owning good businesses, keeping your costs low, staying diversified enough to weather storms, and giving your money the time it needs to grow. You don't need to outsmart the world to succeed. You just need to stay steady while everyone else gets distracted by it. You're not deficient if your portfolio is domestic-centric. You're not missing out on some secret if you're not chasing foreign returns. So the secret is not out there. The secret is in patience, in cost discipline, in sticking with good business and good value wherever it is. So when you ask, should I invest in foreign markets? Ask first, will this add meaningful value? Or will it just add complexity, cost, and risk? If the answer leans toward complexity, cost, and risk, then ask yourself, why am I doing this? Let your portfolio reflect your strengths, your understanding, your discipline, not the buzz of global opportunity. If your home market offers you business ownership, broad exposure, and good value, that is more than enough. Thank you for your time. Stay disciplined, stay patient, and let the simple power of business ownership over the long run carry you to your goals.